to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 25 in our series for 2025, and today's date is Friday, August the 1st. First, I'll be talking to Charles Zerafa, Senior Finance Broker with Integrity Finance Australia. With over 35 years of experience in business and corporate banking, Charles works with clients who are struggling to get finance from banks. Charles, who knows the banking industry, knows how to organise finance for all his clients. And I'll be talking to Indeed economist Callum Pickering about the latest jobs figures, the surprising spike in unemployment, and what's the outlook for the jobs market when the Australian economy is hardly growing. But first, let's talk to Charles Zerafa.
Well, Charles, you've been now working as a broker for how many years? Decades?
Been mortgage broking at Integrity Finance for the last 4 years.
Yeah.
But I've spent 35 years in the banking and finance industry in predominantly in relationship management and analytical and as an analyst working for the major banks. Yeah.
So, who are your clients?
I've got a lot of variety of clients. I've got a few commercial construction builders. I've got manufacturing companies. I've got retail companies. I've got property investors. I've got a few syndicates where there's families or people with related, similar interests buying properties together. So yeah, very diverse range of clients actually. But generally, as I said, I'm specialised in doing commercial lending, property secured or non-property secured, about 1 to 50 million. So wide variety of client bases. Yeah.
Right, and you provide them with the finance for that?
Yep. As I said, I negotiate the finance for them and help them put them in a better position so they can continue to borrow and grow and improve their profits. So I help trading businesses improve their profits or help investors get into their next property or build their portfolios.
So have you found the market over the last 5 years?
5 years. I started in 2019 just before COVID hit. So the market was up and down. Obviously, there was not much happening in the first few years. It was mainly people refinancing to get better rates during COVID because they had time. They had a bit of time on their hands. So there was a lot of refinancing happening at that stage. The last few years, I was doing a lot with property developers and helping them get their developments completed. And in the last few years, since the rates have risen, those development deals have slowed down a bit because the cost of doing these developments are just way too high. A lot of them aren't feasible anymore. So I've in the last sort of 18 months, I've been doing a lot more with operating businesses and helping them expand. So everyone's been through there's a sector of the industry community that's still profitable and going strong in this environment, but there's some in the last few years that have struggled and the costs of the expenses has actually taken a toll on them. Their profits have suffered and they're having trouble obtaining finance. So they seek out someone like myself to help them get back on track, secure the finance they need to keep their businesses moving forward and growing.
The banks aren't that receptive?
It's complicated. That's what it is. So the banks don't have time to really delve into people's finances when it's too complicated. They sometimes don't have the skill, sometimes they don't have the time, or they take such a cautious approach that they give them, they don't give them the amount of money they want, or they give them really high rates. And so and business owners that have been around for a long time know when it's a good deal or not. And they will seek me out to say, well, look, can you do me a better deal than what the banks are offering me? And I'm saving, just through restructuring clients' existing finances, I'm saving them tens of thousands of dollars a month.
But more to the point, the banks don't have the time to develop the relationships.
No, lots of people maybe it's the clients I'm seeing, but a lot of them have got very complex corporate structures. Every director's got personal debts. They've got investment. They've got an investment trust where they've got some investment loans. They've got their operating business that's got funding requirements, and then they're often doing a little side project where they're doing a subdivision or a small investments in other areas as well. So when they're trying to assess their borrowing capacity, they're taking such a conservative approach with everything. But by the time you sensitize all their income, there's not a lot left. So and the bankers just don't have the experience to be able to really get their head around what's happening. And as I said, they always take that conservative approach, and often they're just, as I said, they can't meet it on paper according to the bank's facilities, but that's because they don't know how to structure the loans properly. Sometimes you've got to start from scratch and restructure all the clients' loans in order to increase their borrowing capacity as well. So there's things that I do differently than how a bank would approach things. But yeah, everyone's finances are complicated, and the solution that you got to do to get them into a better position involves, sometimes it's a couple of steps. So a client might come to me for a commercial property purchase and they can't afford it today, but we work with their accountants to try to get them in a position to potentially purchase it in the next financial year.
What have been the big challenges for you?
Getting people to understand what's different about what I do as opposed to other financial brokers, because everyone has this perception that all finance brokers are the same. But because of my background and experience and my intimate knowledge of risk and how the banks work internally, it's a much bigger advantage than the other brokers. So yeah, it's not until a client or a referral source uses my services, then they realise how much value I'm adding, and that they really understand what I do and how I do it differently, and how I get better results. So yeah, getting people to understand the value that I add.
And that's something you've developed over the last few years?
Oh no, as I said, I'm using my bank and corporate training in the banking industry to help clients. So the simplest way I usually explain it is, the banks try to de-risk their clients, and they want you to put you in a better position so they have less risk on their side. Where now I'm working essentially for myself. I'm helping business owners increase their profitability so they can continue to grow and achieve their financial goals. So no, it's loan structuring, loan negotiation, understanding the client's position, and structuring a solution that maximizes their position is a skill set that you don't acquire over 5 years in banking. I find a lot of commercial brokers have only been in the industry, have only worked in the banks for, say, 5 years or so, and you don't acquire that sort of skill set in such a short time. It takes a while to sort of go through so many different loan applications to acquire that sort of skill.
So how many years of experience have you had working for banks?
35 years.
35 years.
Yeah.
So
I started my career in the banking industry. I did my little graduate program basically in the back office, and then quickly ended up in their risk department. So I started off as an analyst before I went into relationship management and working with small business. And then I spent my whole career, as I said, working all the way up from under $1 million to 1 to 3 to 3 to 5 to 5, 5 plus, and in all those segments. And I've been a relationship manager and analyst in all of those segments too. So I've worked with every size business and every business in every life cycle too, startups to succession planning to directorship changes, buyouts, all that sort of stuff.
So why did you leave the banking sector to go into finance broking? I mean, banking was a very secure job, wasn't it?
Yeah, it was. I always wanted to work for myself, but I waited till my children were a little bit older, and I did a few investments myself. I was a bit of a property investor. My brother's a builder, and we've done a few partnerships together. And I wanted to just get my mortgage down until I was in a financial position that I could, start the business, work with, be home for my kids and available for them a bit more, have a bit of a better life balance. And yeah, I sort of timed it, but the bank went through a little bit of some changes at CBA before I left. So I was with CBA for the last 11 years, and they were starting to tighten up their credit policies. And I'd spent 11 years growing all my clients, and then they started telling me that I had to sort of put the stoppers on a lot of clients, and they'd reached their borrowing capacities. And I just said that was the time that I knew that I needed to go and work for myself. And I knew there was other options for these clients, but I couldn't sell anything else but CBA products. So I knew I could add value to all of my clients, but I knew that was the time that it was that I was ready to make that move.
Did you actually take clients from CBA to your own business?
Well, they followed me actually. I had a 6 months non-compete clause, but a lot of them called me up and actually found me online. Charles Zerafa is a unique name. I was easily Googleable, so they all found me on LinkedIn and started calling me straight away, saying, where have you gone? What are you doing? Can we pick up where we left off? And I was, only more too happy to oblige.
So where do you see your business in 5 years' time?
I'm working with business coaches to sort of develop a system where I'm sort of like an accountancy model. So I want to have a decent sized corporate or business clientele that and provide a premium service to clients that are interested in really pushing to achieve their financial goals. So yeah, I see myself as having a couple of staff and a few hundred clients that value what I do and want to work together.
Well, Charles, it's been terrific talking to you. Thank you very much for your time.
Wonderful. Thank you very much. Appreciate
Thank
it.
you.
Have a great day.
And now let's talk to Indeed economist Callum Pickering.
Well, Callum, the latest unemployment figures showed a spike in unemployment, went up to 4.3%. What's your view about that?
Look, it was a little bit of a surprising result. It certainly caught most market watchers by surprise. They'd been anticipating the unemployment rate staying at 4.1%, which of course was roughly the level it's been for much of the past 12 months. So spiking to 4.3%, which was the highest since November of 2021, was a big surprise. And it came off the back of some pretty weak employment figures, up just 2,000 people in the month of June. That followed a similarly weak May result as well. So we've now had a couple of months of disappointing labour market figures, which suggests that maybe the market's shifting a little bit after being pretty stable over the previous 12 months.
The RBA kept rates on hold following that.
Well, they certainly did. And it's a result that increasingly seems like it was a bit of a mistake. The job market certainly appears to be somewhat weaker than maybe the RBA had initially anticipated. They were forecasting that the unemployment rate would reach 4.3% by the end of this year. We've now reached it by mid-year, so we're tracking a little bit ahead of those forecasts. And that suggests that there is a stronger case now for them to cut rates when they meet in August.
Where do you see the figures heading?
Well, it's interesting. I mean, there are still some reasons to be optimistic about the labour market. But indeed, I spent a lot of my time looking at forward-looking measures of labour demand, job posting figures and things like that. And they remain still pretty healthy. There's a lot of jobs being created. And of course, the jobs that are being created today are typically the jobs that are filled, next week, next month, and so on and so forth. So normally when I would look at those job posting figures, I would say, okay, well, that's a sign that future employment should be pretty strong. So I think that's one of the things that I would look at and say, okay, well, maybe things aren't quite as bad as that 4.3% unemployment rate suggests. Maybe it's an aberration. I mean, we do have a lot of volatility month to month in the labour force figures. They can sometimes take us by surprise, but sometimes that's only temporary. And so if all these forward-looking measures of labour demand remain pretty strong, then maybe the job market will snap back and employment might pick up in the coming months. Maybe the unemployment rate might stabilise or even come down a little bit. So I think there is still some pause for optimism out there. It's not all doom and gloom, even though obviously a big increase in the unemployment rate is obviously not something that we want to see.
But sort of rising by 0.2% is not that significant, surely.
I mean, sometimes it can. It all depends on what it's signalling about the economy. Now, in absolute terms, a 4.3% unemployment rate is still pretty good. I mean, it's still pretty low by historical standards, but it represents a bit of a break from where we've been over the past 12 months. So could that be signalling a shift in labour market conditions? It's obviously been a very challenging economic environment over the past year or two. Many households and businesses have struggled, but it hasn't necessarily fed through to, a reduction in sort of labour market outcomes. Maybe that is slowly beginning to shift. It was always going to be sort of unsustainable for the job market to continue to thrive if the economy itself is doing poorly. So maybe those dynamics have shifted a little bit. But it always takes more than a single monthly outcome to get a sense of what we're seeing. Just a 1 month increase of 0.2 percentage points isn't enough to safely declare that the job market is entering a different phase. But certainly if we saw another 4.3% result when the July data comes out next month, then you begin to think, okay, well, maybe we're looking at something a little bit different from what we've been experiencing over the past year or two.
And frankly, the economy has not been travelling that well. It's been fairly stagnant, and productivity hasn't been that great either.
That is a very fair assessment. The economy itself has not been doing particularly well. Growth has been lackluster, to say the least, over the past year or two. And one of the interesting dynamics has been that we've had that poor growth, and yet the job market has continued to thrive. It's continued to perform really well. And one of the reasons for that was because in that post-pandemic job boom, a lot of businesses were operating below capacity from a headcount standpoint. They just couldn't find enough people. They were operating with far fewer staff than they would have preferred to. And so even as the economy weakened somewhat and maybe demand softened for a lot of these businesses, they still needed more workers. They still needed to sort of catch up on where they wanted to be because they were unable to find sufficient staff in previous months or previous quarters. Now, perhaps the impact of that has shifted a little bit. Maybe a lot of businesses are operating closer to where they need to be from a headcount standpoint, and maybe that could impact labour demand going forward. It's not necessarily what we're seeing on the Indeed platform. I mean, we continue to see a lot of jobs being created, which is one of the reasons why I am optimistic about employment growth going forward. But in order for employment growth to remain strong over, say, the next 12 to 24 months, we do need to see a big turnaround in economic growth. I mean, you're not going to continue to see strong job growth if the economy itself continues to struggle. And that's obviously where we've sort of been over the past year or two. So that dynamic really has to shift if we want to continue to have a thriving job market.
So the economy really has to pick up.
At some point, yeah. Yeah, I mean, if you have an economy that's operating like a downturn, which is what we've had, where GDP per capita has been contracting, which is what we've had for the past couple of years, then it's not sustainable from an employment standpoint. At some point, that's going to hit employment. We haven't necessarily seen it yet, but it will inevitably happen at some point, unless economic growth picks up, which is what you'd hope to see. Certainly, the RBA expects economic growth to pick up over the next 12 to 18 months. Treasury expects exactly the same thing. But if that isn't realised, then you begin to be a little bit worried about where we might be headed from a job market standpoint.
From an RBA perspective, employment growth expectations aside, if there's an increase in unemployment, it would actually help drive down inflation.
Yeah, certainly would. I mean, that is the long run relationship between it. The looser the job market is, tends to be the lower inflation is. And right now, inflation has been heading in the right direction for the past year or two. Headline inflation is obviously quite low at the moment. It's being pushed lower because of things like government subsidies. But even underlying measures of inflation are heading in the right direction and heading towards the middle of the RBA's 2 to 3% target band. Obviously, ongoing weakness in the economy, a weaker job market would also then feed into that, which could potentially drive underlying inflation maybe into the lower part of that 2 to 3% target band as well. So these will be the things that obviously the RBA will be thinking about as they head towards their August meeting.
One of the things that you would have picked up at Indeed is that people are still looking for skilled workers.
Well, that's right. I mean, there's still a lot of demand out there for workers of all skill levels, actually, but particularly highly skilled workers are always in high demand, and they're often the jobs that are the hardest to fill. Some recent research I've been looking at has actually been around, graduates and the demand we're seeing there. And we continue to see a lot of jobs being created for recent university graduates. So these are these skilled entry-level roles. They're often graduate programs that big companies run. They're often sizable programs. They might be looking for, 15, 20 graduates to come join certain companies. So that's a good sign, obviously, particularly given that graduate employment tends to be one of those areas where you hire someone maybe in April or June of a given year, but then they often don't start the job until the next year. So it often provides some insight into how employers think a job market might evolve over, say, the next 12 months or so, because it is such a forward-looking measure of demand because of when those jobs actually start. So that's a sort of interesting dynamic that we're seeing in the job market at the moment, that it's still holding up pretty well in the skilled space.
The other interesting thing to ask is, were there any particular sectors where the joblessness was high?
Well, we don't have industry breakdowns, unfortunately, at the moment. We will actually wait a little bit for that. So it's not particularly clear. I mean, one thing that we can say is that a lot of the weakness in employment in the month of June came from New South Wales. Victoria actually held up pretty well. I think Queensland was a little bit weaker as well. So that might provide some insight into it from a regional standpoint, but we're not entirely sure what might be driving this recent weakness from an industry standpoint. We're going to have to wait actually until we get August industry data to have a proper insight into that. On the Indeed platform, we continue to see reasonably good job creation across the board. So most of the sectors that we do look at are still above pre-pandemic levels, just in terms of the sheer volume of job postings that are out there. So that does suggest that most sectors are doing okay from a labour demand standpoint. But we have seen some imbalances from an employment standpoint over the past year. So there's certain industries like healthcare, for example, public administration, even education, where we've seen really strong job gains over the past 12 months. That's offset some weakness in, the private sector. So to the extent that we could guess or speculate about what might be driving the recent weakness in employment, my best guess would be probably in the private sector as opposed to the public sector, which is probably more likely to hold up because they are somewhat insulated from market conditions and economic conditions.
Indeed. I mean, my gut feeling is you'd have a lot of issues in hospitality, the hospitality industry, retail might be another one, and also construction.
Yeah, I mean, they're all very good guesses. As far as speculation goes, they are very good guesses.
Right, okay. So we'll wait and see.
That we will.
Okay, well, Callum, thank you very much for your time.
Thank you.
So what's happening in the news? Well, after tense negotiations, the European Union has averted a tariff war with the United States. It's a broad brush trade deal set at US President Donald Trump's Turnberry Golf Resort in Scotland that sets a 15% tariff on most EU goods, including cars, but not for steel, which was subject to a quota system, and that's down from the 27.5% punitive fee in April. It averts what could have become a painful trade war with a bloc that is the United States' single biggest source of imports. This is higher than the UK, which had secured a 10% baseline tariff. The EU was following this line and had been working towards an agreement that would have kept baseline tariffs at 10% for its 27 member countries, rather than join Canada and China with instant retaliation and inflict pain on US consumers and businesses. The EU, hamstrung by divergent views among its member states, chose to take the path in the hope of securing a better deal. President Trump said that the European Union had agreed to purchase $750 billion of American energy, which Ursula von der Leyen, the president of the EU's executive branch, told reporters would be spread out over 3 years. The 27-nation bloc also agreed to increase its investment in the United States by more than $600 billion above current levels. Mr. Trump said the European Union would buy military equipment as part of a deal. The two sides also agreed to drop tariffs to zero on a range of goods, including aircraft, plane parts, certain chemicals, certain generic drugs, semiconductor equipment, and some agricultural products. Ms. von der Leyen said, altogether, while it was clear that major details still needed to be hammered out, the framework seemed likely to permanently reshape the trading relationship between two of the world's largest and most interconnected economies. The agreement will rebalance but enable trade on both sides, Ms. von der Leyen said, as she sat next to Mr. Trump and the leaders made the announcement. Not all higher tariffs were eliminated. The president implied that the 50% tariff he'd impose on steel and aluminium globally may remain for some products, saying it's a worldwide thing that stays the way it is. Ms. von der Leyen suggested that those might be reduced through further negotiations. That said, it was not an easy deal for the European Union. Europe, being what it is made of different views and disagreements. True, there was relief among policymakers about avoiding an immediate transatlantic trade war. The trade war-ending deal has been welcomed by most EU leaders, but with a significant dose of scepticism. The agreement with Trump was tinged with regret. Could the EU, the world's largest trading bloc and supposedly an economic heavyweight, have extracted better terms had it not pulled its punches early on? He's a bully in the schoolyard, and we didn't join others in standing up to him, said one diplomat. Those who don't hang together get hanged separately. The EU knew that Trump says that the EU is a parasite, feeding off the lucrative US market while closing its own through regulation and standards. The US president has said the union was formed to screw the US and nastier than China. Germany, France, and a few others pushed for the Commission to consult on using its new trade bazooka, the anti-coercion instrument. Designed after Trump's first term to counter trade policy being used to pressure governments over other matters, it would allow Brussels to bar US companies from public tenders, revoke intellectual property protection, and restrict imports and exports. However, it was not clear a majority of member states agreed with a threatening move. This was why the EU finally agreed to that deal. Still, French Prime Minister François Bayrou said the deal amounted to submission by the EU. Added to that, US President Donald Trump has flagged a new, higher baseline, leaving Australian exporters facing the prospect of tariffs of 15 to 20% at the United States border, with the Albanese government yet to strike a deal. The Australian government has so far stood back from negotiation, given about 24 billion of Australian goods sold to the US annually have been subject to the lowest rate, and there was so far no expectation that carve-outs would be applied to that baseline. As such, the possibility of a new, higher baseline rate will likely come as a shock to Australian officials and to the meat, gold and pharmaceutical vendors that make up almost half of the country's US-bound exports. And Australia and the EU are unlikely to strike a trade agreement this year. After negotiations between Australia and the EU collapsed in October 2023, the parties rekindled talks in June this year, as both sought insurance against the impact of Trump's global trade war. European Commission President Ursula von der Leyen, whom Anthony Albanese met in Rome in May, and again in Canada a month later, had penciled in a visit to Australia early in the second half of this year, but there's little likelihood of that happening in 2025. Why? Because the EU had become so distracted in dealing with the US. Now it's prioritising its attempt to finalise a so-called Mercosur deal with the South American bloc of nations comprising Argentina, Brazil, Paraguay and Uruguay. When Trade Minister Don Farrell met his EU counterpart Maros Sefcovic in Paris in early June, he was assured that the Mercosur deal would soon pass the European Parliament, enabling the Europeans to focus on Australia. But because of its high agricultural content, mainly beef, it was blocked by the French, and the EU's focus is on trying to salvage that deal. After that, it wants to deal with India. Let's cut to the chase. Australia, which is at the other end of the world, is not a priority for the EU. And the Reserve Bank of Australia has been given the green light to cut interest rates in August, with inflation dropping to its lowest level since the March 2021 quarter. CPI eased further in the June quarter, with consumer prices rising at an annual pace of 2.1%, down from 2.4% in the March quarter. This was lower than the 2.2% expected by economists polled by Reuters. The trim mean measure of inflation, which is the Reserve Bank's preferred measure of underlying inflation, also declined, falling from a 2.9 to 2.7% between March and June, which broadly matches the Reserve Bank's forecast from May. On a quarterly basis, Bureau of Statistics data shows headline inflation rose by 0.7% in the June quarter, down from the 0.9% pace in the March quarter. And to boost Australia's flagging productivity, the Productivity Commission will recommend the federal government offer a more generous immediate tax deduction for new investment by companies. The aim is to boost non-mining business spending that has declined over the past 15 years and which has dragged down Australia's productivity. To incentivise new business investment, the Commission will this week advise Treasurer Jim Chalmers to move towards a corporate cash flow tax model, enabling companies to receive a larger upfront tax deduction for capital outlay. Certain businesses and types of investment would be rewarded with a larger immediate write-off for new capital outlays, instead of having to gradually depreciate the cost of investment over up to 10 years, under the proposal in a report to be released publicly on Thursday. The faster tax benefit flowing to business would cost the federal budget potentially tens of billions of dollars in the early years, but be almost revenue neutral over 10 years due to lower future depreciation deductions. Deductions for interest expenses would also decline as a result of the more immediate expensing of capital investment. To limit the fiscal cost of the proposed tax change, not all types of business investment would be eligible for full expensing, with the proposed model to be a partial form of a more pure cash flow tax. Productivity Commission Chairwoman Danielle Wood said the interim report would make recommendations to the government to adjust the corporate tax to boost business investment, but she ruled out a cut to the 30% rate. And while we're on the subject of productivity, one of the nation's biggest agribusiness operators has urged an overhaul of freight infrastructure, particularly rural roads and rail, as a rapid-fire way to help boost flagging productivity. Wheat and grains major GrainCorp also wants a streamlining of fragmented environmental and trade regulations as a way to slash compliance costs and spur investment into regional Australia. The comments were made as part of GrainCorp's submission to Treasury ahead of the Albanese Government Economic Reform Roundtable in August. Inefficiencies in freight and logistics infrastructure, a lack of investment in rural roads, short rail sidings and port congestion all slows the nation's agricultural supply chain and result in significant costs for growers and exporters each year. Australian grain freight costs are more than triple those in countries such as Canada and Ukraine, placing pressure on farm gate prices and export competitiveness, GrainCorp said in the submission. These cost pressures are compounded by ageing infrastructure, inconsistent investment and limited interoperability between state networks. With global demand for reliable low emissions supply chains increasing, Australia cannot afford to let poor infrastructure remain a barrier to growth in regional industries like agriculture, it said. GrainCorp markets and ships grain on behalf of 10,000 growers across Australia. Combined sales of wheat, barley and sorghum represent the nation's biggest agricultural export. And Labor will significantly increase the number of renewables projects it will underwrite in a bid to speed up the clean energy rollout as the government's 2030 targets look increasingly out of reach. Climate Change and Energy Minister Chris Bowen on Tuesday announced a 25% increase to the size of the Capacity Investment Scheme, Labor's program to boost private investment in renewables by providing minimum revenue guarantees for new clean energy projects. Despite strong investor interest in renewables investment, the government is well behind its target of achieving 82% renewable energy generation by 2030, which underpins its commitment under the Paris Agreement to reduce emissions by 43% on 2005 levels by the same date. And trillion-dollar Dutch pension fund APG Asset Management has defied the recent trend of international investors exiting Australia's clean energy sector, committing more than $1 billion to expand the renewables platform of developer Octopus Australia. APG's move is one of the most significant institutional investments to date in Australia's clean energy transition, which needs to accelerate it if it is to meet the federal government's target of 82% of power generation from renewables by 2030. Octopus Australia Chief Executive Sam Reynolds said the funding would allow the firm to double its already large pipeline of solar, wind and battery projects over the next 5 years. Our pipeline is about $11 billion today, but with the firepower that APG can put behind us, we'd expect that to double over the next few years because it gives us confidence to develop, go in and buy and originate more assets, Reynolds said. Octopus Australia is a sister company to the UK-based retailing and tech company Octopus Energy, which is 23% owned by Origin Energy. The Australian company's investors include superannuation funds REST and Hostplus, international funds and the federal government's Green Bank. The first funds from APG into Octopus Australia will be deployed in September at the $900 million Blind Creek solar and battery project near Bungendore in New South Wales, and the 1 gigawatt $850 million Blackstone battery project in southeast Queensland. The group's projects that are already operational in Australia include the 275 megawatt Darlington Point solar farm in New South Wales and the 181 megawatt Dulacca wind farm in Queensland. It is also in the process of developing a line of projects along the eastern seaboard, including the Fulham Solar Farm and battery in Victoria, taking its total assets in operation or development to more than 4 gigawatts. And global pharmaceutical giants, including Pfizer and Johnson & Johnson, are paying a tiny fraction of the billions of dollars they earn from drug sales in local taxes, at a time when they're lobbying US President Donald Trump to force an overhaul of Australia's pharmaceutical benefits scheme and impose a 200% tariff on Australian pharmaceuticals. An analysis of earnings statements filed with the corporate regulator by 5 of the biggest US and European drug makers shows the companies on average pay between 2 to 4% of the Australian sales in income tax. The numbers may make for uncomfortable reading for drug multinationals as they step up efforts to loosen the PBS grip on the pricing of key medicines. Vaccine maker Pfizer paid $43.5 million in income tax on its $1.1 billion in sales in Australia in the year to November 30, 2024, accounts lodged with the Australian Securities Investments Commission show. Johnson & Johnson paid $27 million in local taxes on sales of $1.46 billion for the year ended December 31st, 2024, while weight loss drug company Eli Lilly recorded sales of $462 million and income tax payments of $5.2 million for the same period. Collectively, multinational drug companies booked $5 billion in Australian revenue last year, but the weak profit margins meant they only paid around 2 cents in the dollar in tax. While there's no suggestion that the companies are doing anything unlawful or not complying with their tax obligations, the amount of tax they pay in Australia could come under scrutiny because of their criticism of the PBS, which has been linked to Trump's trade tariffs, and the amount they receive for drugs sold in Australia. Australia says it's not budging on the PBS. And Ansett Australia, formerly owned by Air New Zealand, which collapsed into administration nearly 24 years ago and at its height was the country's second biggest airline, has made a surprise triumphant return to the travel industry as an AI operator travel agent known as the Ansett Travel Platform. Melbourne tech entrepreneur Konstantin Frantsekos is the brain behind the new Ansett. He said he spotted a quiet opportunity when he noticed the once famous Ansett trademark had lapsed. I registered the trademark, created a fleet of AI agents, have now turned Ansett into a one-founder online travel agency, Fransekos said on LinkedIn. Fransekos claims Ansett is the country's first truly AI-run travel agency and said it uses artificial intelligence to shave money off the price of hotels, flights and holiday packages. His new website is already live with advertisements for holiday deals to the likes of Tokyo, Athens, Las Vegas and Bali. A notorious Melbourne underworld figure, Mick Gatto, gave more than a dozen Versace gold bracelets to Victorian CFMEU officials he considered his closest allies or to those he wanted on side, including the most powerful branch leaders along with the union's up-and-comers. Versace chains are favoured among the underworld and retail from between $1,000 to several $1,000s, depending on the design and any extras, such as diamonds. The recipients include former Assistant Secretary Derek Christopher, who remains subject of an unrelated police investigation into suspicions he received kickbacks from large building companies in return for favourable treatment, and Joe Miles, the ex-union vice president accused of helping to recruit bikies into the CFMEU. The revelation of Gatto's gold gifts marks another scandal for a union drowning in scandals and puts Albanese government-appointed CFMEU Administrator Mark Irving in an invidious position, as some of the gift takers are still key officials helping rebuild what was once the country's most powerful union. Rules cover union officials accepting gifts from players in the industrial system to avoid perceptions of conflicts of interest or undue influence. As lead investigator for the administration, Jeffrey Watson SC wrote in an interim report late last year that union officials he interviewed described Mick Gatto as a friend or a person who came with the furniture of the job. Watson found this so concerning because Gatto is not only a gangland figure, but at times was engaged in inappropriate and murky roles in union disputes. And that's it for this week. And next week I'll be talking to Tim Bhatnagar, co-founder of Payverse, about how his platform ensures that all luxury NFTs have provable provenance and are free of fraud. The platform seeks to be the primary destination for luxury brands to market and for consumers to buy and sell their luxury goods via blockchain technology in a secure, transparent manner. And I'll be talking to Rabobank economist Tuva Mevison about how China's economy is faring in the wake of the tariff war with the US and tensions with the EU. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you can find me on Facebook, Twitter, or X as it's now known, Instagram, LinkedIn, and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles, or advertorial, email me. Looking forward to the next episode of Talking Business.